A false breakout is one of the most reliable ways to lose capital. You identify a level, price breaks out, your order fills, and the market immediately reverses, trapping you in a losing position. Standard Donchian channel systems dictate that you take every single break of the upper or lower boundaries. When price action tightens into a narrow, sideways range, this mechanical obedience becomes a serious liability. This diagram shows a market stuck in consolidation. Price pokes above the upper band, triggers long, and instantly snaps back. It breaks the lower band and reverses again. A red indicator tracks accumulated losses, chipping away equity while the market goes nowhere. A plain breakout system forces you to buy the highs and sell the lows of a chop zone. By failing to filter out the noise of low volatility chop, it steadily erodes its own statistical edge. A mechanical system requires algorithmic context. It needs a strict mathematical rule that tells it when to ignore a valid price signal. The pattern rotation strategy is engineered to provide exactly that context. It uses a volatility regime classifier to objectively measure the market conditions before a trade is ever authorized. The mandate is rigid. Skip the structural chop entirely and only deploy capital during mathematically proven expansion phases. By refusing to participate in low volatility environments, the system preserves your capital for high probability continuation setups. This chart displays the primary entry mechanism, a standard 20-period Donchian channel. The muted gray arrows mark every instance where price closes past the previous 20 bars. To filter these triggers, we calculate a regime classifier by dividing a recent average true range, or ATR, by a longer baseline ATR. The exact parameters for this ratio divide a fast 14-period ATR window by a slower 50-period baseline window. The subchart below tracks this ATR ratio. It creates an objective mathematical threshold for market activity, marked exactly at 1.0. When the ratio is 1.0 or higher, the baseline volatility is exceeded. The subchart colors the area green to denote an expanding regime, an active trading zone. When the ratio drops below 1.0, the market is contracting. The zone drops red, restricting all entries. Combining these two rules builds the final system. Long signals fire on upward breaks and short signals on downward breaks, but only when they align with the green expansion zones. The triggers trapped in the red zones fade away completely. The strength of this logic lies in its inaction. During contracting regimes, the strategy stays perfectly flat with zero market exposure. With the entry mechanics established, we shift focus to the post-entry trade management rules. Pattern rotation avoids trailing stops or complex scaling out of positions. It relies strictly on rigid bracket exits. Looking at this single valid entry trigger, rigid horizontal lines instantly appear above and below the entry price. These are fixed take-profit and stop-loss orders, defined by precise instrument points. The system requires that only a single position is held at any given time. Once the regime filter authorizes the entry, the risk is mechanically boxed in. It requires absolutely zero discretionary intervention. To test this logic against market reality, we ran the data over a 5-year period from January 2020 to December 2024. The test parameters control for a 1-hour timeframe, $100,000 in initial capital, and a realistic model for slippage and commissions. The NQ 1-hour matrix reveals NASDAQ 100 performance. Across 883 trades, it produced $178,151 net P&L, a 36.69% win rate, and a 0.95 Sharp. Profit factor hit 1.16 alongside a 4.17 recovery factor. The upward charting equity curve restricts maximum drawdown to 23.95%. Intraday equity index futures, like the NQ, naturally alternate between clean, directional expansion and tight periods of consolidation. The ATR filter maps accurately to the NASDAQ's inherent behavioral structure, reliably triggering entries when actual trend extensions occur. The necessary quantitative question is whether this logic holds up universally across different asset classes. Testing identical mechanics on the S&P 500 and gold reveals stark contrasts. The ES underperforms, generating only $29,222 net profit and a 0.29 Sharp. Gold yields a catastrophic failure. Its $13,726 net profit is dwarfed by a brutal 52.74% max drawdown and a 0.15 Sharp. Gold exhibits a different volatility structure. On a 1-hour chart, it does not cleanly alternate between expansion and consolidation regimes the way tech equities do. There is no universal rule set. An algorithmic edge only exists when its mechanical rules map directly to the structural behavior of the specific underlying asset. Analytical objectivity requires exposing the system's blind spots. The most prominent is the strict timeframe dependency of the ATR filter. Applying this to a daily chart renders the filter nearly useless. Daily volatility regimes shift too slowly for a reactive ratio to prevent whipsaw entries. There is also a structural opportunity cost. By forcing the system to stay flat during contraction, it abandons any potential mean reversion trades. Pattern rotation is a highly specialized tool. It is exclusively a regime-aware continuation strategy, intentionally blind to low volatility edges. Filtering plain Donchian breakouts through a comparative ATR ratio improves trade economy by keeping capital flat and safe during structural chop. Its ideal deployment zone is on intraday index futures, specifically the 1-hour timeframe, where active and quiet phases clearly alternate. To verify the data, review the complete, granular order tape, which lists every fill, commission, and timestamp for these runs. You can test your own custom parameters and contracts by running the backtests on the platform. In systematic trading, evidence must replace guesswork. Only rigorous, realistic backtesting can validate if a mechanical theory actually holds up to market reality.
So, if you loved this content and found it valuable, please share it. And of course, make sure you click like on this video and subscribe to our channel. Thanks for watching.